try to understand what is this world of structured finance. Today, lot of buzz about this particular term, structured finance, structuring process, and we'll also talk a bit about ring-fenced assets. What are these types of assets which fall into this category of ring-fenced asset? How does structuring help a particular company, and how we do the structuring, and finally looking at the tranching and subordination based on the structuring process, right? So this is what we will try to understand. Probably let me take it as a smaller, simpler session, but good to understand because it is something that is playing an important role in the day-to-day finance. So with that background, if I want to get started, first trying to understand what is structured finance all about. When we use a new field of finance called a structured finance, it involves creating financial assets and new instruments, creating new financial instruments which are not standard. When we say not standard, they are not the traditional equity or bond kind of instrument. Generally, it's like, okay, bonds combined with some kind of derivatives. Bonds combined with some kind of options, or some kind of embedded options itself, which can alter, which can change the cash flow positions. It's not a traditional fixed cash flows that are going to come. In some cases you may get a more cash flow, in some cases you may get a lesser cash flow. So by doing some kind of these structurings, the prime motive for any company is to reduce its risk profile. Reduce its risk profile so that it can raise capital at a much cheaper rate, so which will result in low financing costs. That's the prime objective, because that will result in improvisation of the credit profile of the company, which could result in a lowering of the financing costs. So how to do it? It is more and more dependent it differs from company to company, right? So primarily it is like the firm is getting into issuing of secured debt, right? It could be viewed as a firm issuing a secured debt by pledging some assets. So it could be a fixed assets, it could be current assets, whatever it is. By pledging some assets as a collateral, it's as good as the firm is issuing a secured debt. Now, because of getting into a secured debt issue, the firm is able to lower its financing costs. And at the same time, in case there is any kind of a liquidation, the lender would have an access only to this pledged collateral and not the general claim on the overall assets of the company. So when we are pledging this kind of asset, sometimes what could happen is the